Okay, can you hear me? Please, can you hear me?
Yeah, I can.
Okay, okay, awesome. So I think I'd have to go over it again. So let me just do the return on equity. So what does return on equity tell you? It basically tells you the return on the shareholders' investment in the company. So it measures the return of the shareholders, or the return on the shareholders' investment in the company. So it is basically it is basically calculated by dividing the net profits by the total equity. So it actually measures like how profitable, or how the company can make profits from, like, profits without using a lot of the shareholders equity. So with return on equity, we are basically looking at the company making profits with keeping the shareholders equity very low. So just like the return on assets, basically the return on equity should also be higher to show that the company is profitable. If the return on equity is low, it means that the company can generate a lot of profits without using a lot of the shareholders' equity. So let's calculate the return on equity. So equal to net profits, net profits. So the net profit over the total equity. Then you drag. So this basically shows that the return on equity ratio is very low. So if you are looking to invest in the company, you should know that the company will not be profitable enough to return your money, or to return your amount of money to you within the period that you want to, like, within the period you want to get your money back. That's why it's basically advisable to do all these ratios to know if really you are going to get your loan back, or you are going to get your return on your investment after the specified period has been exhausted. So we are done with profitability ratios. I said earlier that you should know that profitability ratios are used to measure how the company can make profits from the net profit, the gross profit, the assets, and then the equity without using a lot of assets or a lot of equity. So we are moving to the next ratio, which is the efficiency ratio. The efficiency ratio. So what then is efficiency ratio? Efficiency ratio is basically measures the company's ability to manage its assets and liabilities in an efficient manner. So every company has assets, every company has liability. How then are you able to make the most out of your assets, the most out of your liabilities that you have, with, like, when you are working, or when you are using those things? So that is when efficiency ratios coming to show, or whether you can be able to manage your assets or your liabilities efficiently to be able to bring out the desired outputs that the company would want. So now let's move to the first one, the assets turnover. So the asset turnover. So efficiency ratios. Efficiency. Okay. So we have the asset turnover. Asset turnover. So what is asset turnover? The asset turnover ratio, it measures like the efficiency with which like a company is using its assets to generate revenue. So basically looking at how the company is managing the assets to generate the required revenue that the company wants. So with this also, a higher ratio suggests that the company is using its assets effectively to generate revenue. So with asset turnover, the formula is the total revenue over the total assets. So sometimes when you are doing these ratios, you can actually use the name of the ratio to actually help you with what you are going to be using. So now, like I said, asset turnover is used to measure the efficiency with which like the company is using its assets to generate revenue. So let's calculate the asset turnover. Asset turnover. So now asset turnover is equal to the total revenue or the sales. So this is the revenue or the sales over the total assets. So total assets, we have this, and then this is what we are getting. So with this, it means that like, well, it's lower than one. It's lower than one. It means that the company doesn't really is not really efficient in managing the assets of the company. So it's not really efficient. So it can't really generate a lot of revenue from the assets. So if it was more than one, then we would have been able to conclude that the company is efficient in managing the assets to generate revenue. But here is a case where we are getting it lesser than one, meaning that it's not really efficient. Well, it's a bit closer to one than farther than one, but then it's ideal if it's like more than one. Yeah. So that is asset turnover. We move to let me check the next one. The next one is the inventory turnover. So inventory turnover. So what is inventory turnover? Inventory turnover is also used to measure how often the company sells or replaces its inventory. So how quickly the company can sell off inventory and then replacing its inventory. So if with this also, if the answer or the ratio is high, it means that the company quickly sells off its inventory and then replaces its inventory quickly. So how do you calculate inventory turnover? Inventory turnover is calculated with this. You would just think that you are going to use the inventory over like, so with this, you are just going to look at the inventory over the average inventory. But then it's basically the cost of goods sold. So cost of goods sold. Because here we are looking at how quickly the company is able to sell off its inventory. And cost of goods sold is what is going to give us that measure. So over the average inventory. That is the formula for inventory turnover. So now let's compute inventory turnover. So equal to the cost of goods sold. So this is cost of sales So we don't have the cost of goods sold here. So if we had the cost of goods sold here, 100,000. So the cost of goods sold would have been somewhere here. So the cost of sales is also the cost of the goods sold. That is the cost of sales. So we are going to use this to calculate the inventory turnover. So the cost of sales is also the cost of goods sold. So now let's calculate the inventory turnover. So equal to cost of sales over the average inventory. So we don't have average, so we have inventory. So we are going to use inventory. We don't have the average inventory, so we are going to use the inventory. Okay, so we hit enter, and then so we are seeing that it's higher. It means that the company is able to, like, the company is very efficient when it's selling of its inventory, and then is also efficient in replacing its inventory very quickly, because we are seeing that it is more than one and it's very high. So that is inventory turnover. Now let's move on to the next one, which is the receivable turnover. The receivable turnover. Receivable turnover. So what is receivable turnover? So receivable turnover is basically how quickly the company is able to pay off like its debtors. That is receivable turnover, how quickly the company is able to pay off its debtors. So let's calculate the receivable turnover. So it's also calculated by the cost of goods sold, cost of goods sold over average. So this one is average inventory. We don't want average inventory. So we are going to use cost of goods sold over average receivable, or it can be cost of goods sold over receivables. Receivables. So, equal to cost of goods sold. Cost of goods sold is the same as the cost of sales over the receivables are also the same as debtors. So receivables are also the same as debtors, the people you owe. So it's equal to the same as debtors. So basically, a higher receivable turnover shows that the company um is like is able to pay off its debtors very quickly. That's receivable turnover. So we move to payable turnover. What is payable turnover? So just like how receivable turnover is used to show how quickly or how the company is able to manage its debtors, payable turnover is also used to measure how often a company pays its suppliers. So receivable is debtors, payable is suppliers or the creditors. So we have the cost of goods sold over the average payables. Now let's calculate payable turnover. Payable turnover is equal to cost of sales over the creditors. Yeah. So the creditors is the same as the payables. So this, and then yeah. So we are seeing that is more, and then it shows that the company is efficient in paying off its creditors or managing its creditors. Yes. So the next is working capital turnover. Okay. So the working capital turnover is also used to know how the company is able to manage um its working capital with the sales that the company has. So now let's calculate the working capital turnover. So it's also calculated as the sales revenue, sales revenue over the current assets minus the current liabilities. So let's put this in brackets. So then the denominator, let's put it in brackets. So current assets minus current liability is the same, is equal to working capital. So let's compute working capital turnover. So equal to sales equal to sales over the working capital. So current assets. So let's bring our brackets. Current assets minus your current liabilities. This, okay. So okay. Okay. So we have the okay, so I think I picked the total assets. So let me just, it's supposed to be just current assets, not the total assets. So let me insert a column here for total current assets. Total current assets. So so equal to sales over your total current assets, and this is what we are getting, more than one. So it means that the company is able to is very efficient in managing the working capital. So that is it for the ratios. There are other ratios that we could look at, but then I think we would have to end here, and then you will just go through it, because there's going to be a project that we are going to assess you based on the project, just like what Jonathan said. So we are done with financial ratios, and you can just practice on your own. We are going to leave this workbook in the Google Classroom, and then also the recording. You can have access to the recording too. Okay, so thank you very much, and it was nice having you all for this session. And I just wish you all the very best in all your endeavors. And then I hope you are going to use this very, very well in the career world too. Okay. Thank you and do have a lovely day.
All right, sure. Thank you. So kindly stop the recording for me.